The Construction Market Guide is designed to provide contractors and construction executives with timely data on the economic environment, materials prices, and the labor market so you can make informed decisions that increase profitability. The central bank in the United States has been, as you know, taking aggressive action to try to get inflation under control by raising interest rates. And what we're seeing is that that's starting to have the desired impact. Materials prices almost across the board here, with a few exceptions, one of those being natural gas, is seeing pretty steep price reductions, with lumber being notably down 26% year over year, iron and steel down 24% year over year. So actually seeing deflation in some areas now with construction input costs. We're also seeing, as we look at forward-leading indicators for the construction market, that the Architectural Billing Index is now in negative territory nationally, not just in certain parts of the country, particularly in the Northeast. But we're seeing negative readings here, showing a shrinking pipeline for new projects in construction. We're also seeing new housing starts off pretty significantly, and the sale of houses down quite sharply over prior time periods. And inflation looks like it's coming under control. The inflation rate, there was the personal consumption expenditures inflation index that the Fed looks closely at, and a recent reading was as low as 4.4%. So it does appear that inflation is coming down. The key area, though, that the Fed still looks at is the unemployment rate, and that has been stubbornly low, which is a good thing, of course, but as we look at the Fed's assessment of it, it creates a little concern that they might stay the course with continuing to raise interest rates. While we're seeing headlines of large companies, particularly technology companies, doing layoffs nationally, demand for employees among smaller businesses appears to continue to be strong, and the unemployment rate remains low. The stock market, again, looking ahead, while many economists expect a recession coming, the stock market's looking farther into the future beyond that and is starting to, at least in the short term here, starting to bounce back early in the year from levels that had been, potentially expecting better times ahead. And the bond market is also making a similar expectation for the future, as we see that shorter term interest rates are higher than longer term, indicating that the bond market continues to believe that the Fed will be successful at getting inflation under control and will eventually start to raise interest rates. If you'd like to sit down with us to talk about your business and your financial plans personally, please reach out to us. We're happy to chat. Thanks.